On August 6th, 2026, Michael Burry disclosed two brand new short positions on his personal research page. Neither one was Nvidia. One of the two stocks he's now betting against is up more than 120% so far this year, and Burry describes shorting it, in his own words, as a bit like shooting fish in a barrel. Some of you think Burry just found his next big short. Others think he's about to get run over by a stock that's already gone up nearly 10 times in 3 years. Tell me which camp you're in, because one of these two companies reports earnings in less than a week. Before we go further, here's why any of this should matter to you, even if you've never bought a single share of either company or ever plan to. If you own an S&P 500 index fund or a NASDAQ 100 fund inside a 401k or a brokerage account, you already own a slice of exactly the AI infrastructure build-out Burry is questioning. Understanding what a sophisticated, historically accurate skeptic is looking at right now isn't about copying his trade. It's about understanding the risk sitting quietly underneath a part of the market most people's retirement money is already exposed to. It also helps to be precise about what shorting a stock actually means, because it's the opposite of how most people invest. When you buy a stock, the most you can ever lose is the money you put in, and your potential gain is unlimited if the company keeps growing. When you short a stock, you're borrowing shares and selling them now, betting you can buy them back cheaper later. Your maximum gain is capped at the stock falling all the way to zero. But if the stock keeps rising instead, your potential loss has no ceiling at all. That's an important detail to hold on to, because it means Burry isn't just making a prediction. He's accepting a genuinely lopsided risk to make it. Burry ran Scion Capital in the mid-2000s, and he built one of the earliest, most detailed bets against the American housing market, years before anyone else on Wall Street took the risk seriously. That trade became the backbone of the book, and later the movie called The Big Short. Burry made an enormous amount of money on that call, and he made it by doing something almost nobody else in finance was willing to do at the time, reading the actual paperwork underneath a popular, universally trusted asset class, and finding the specific mechanical flaw that would eventually break it. He wasn't guessing that housing felt overpriced. He traced exactly how the mortgages were bundled, exactly who was buying them, and exactly what would happen the moment default rates ticked up even slightly. That's the same method he's been applying to artificial intelligence stocks for the better part of this year, and it's important to understand his existing short book before we get to the two new names, because the contrast is the whole story. As of his most recent disclosures, Burry has been running short positions against Nvidia, Palantir, Micron, Tesla, Caterpillar, Applied Materials, and the iShares Semiconductor ETF, alongside put options on the NASDAQ 100 tracking fund, the QQQ. Notice how varied that list actually is. It's not just chip makers. Caterpillar makes construction and mining equipment, and it landed in Burry's crosshairs, specifically because of a 2 gigawatt natural gas generator deal tied to powering AI data centers, meaning Wall Street had started pricing Caterpillar as an AI winner even though it doesn't sell a single chip. That's a pattern worth remembering. Burry isn't only questioning the companies making AI possible directly. He's questioning every company that's been re-rated higher, simply because its name got associated with the AI build-out. He's been candid that this basket hasn't all worked in his favor. As of his Tuesday, August 4th update, Burry said every single one of those positions was profitable except for one. Nvidia, the single most famous AI stock in the world, is currently the one name in his portfolio actively losing him money, even as he keeps holding it. That detail matters enormously for how you should read everything that comes next in this video. This is not a man who's simply right about everything he touches. He's telling you, in his own public writing, that his most high-profile short is currently underwater, and he's still choosing to keep it on. Whatever you think of his conviction, it's not blind confidence. It's a bet he's willing to be wrong about in the short term while he waits for a longer-term thesis to play out. So when Burry adds two brand new names to that list, names that are notably not Nvidia, it's worth asking what specifically drew his attention away from the most obvious, most talked about AI stock on the planet, and toward two companies most casual investors couldn't have named a year ago. Here's exactly what he disclosed. On Thursday, August 6th, through his Substack publication called Cassandra Unchained, Burry revealed a short position in Oracle, ticker ORCL, entered at $144.63 a share. Alongside it, he disclosed a larger short position in Nibius Group, ticker NBIS, entered at $211.77 a share. He didn't disclose the exact size of either position, which is typical of how he shares these updates. But he was very specific about the mechanics of the Nibius trade in particular. Rather than buying put options, which is how he structures most of his bearish bets, he took a direct short position in the actual stock. His stated reason was that implied volatility on Nibius options had climbed above 100%, making the puts, in his words, exorbitantly priced. Think about what that detail alone tells you. Options get expensive when the market expects huge, unpredictable price swings in either direction. An implied volatility reading above 100% on a large liquid NASDAQ-listed stock is an extreme number, and it means the options market was already pricing in the possibility of dramatic moves before Burry ever placed his bet. Now here's the detail that makes the Oracle side of this story a little more layered than a simple new short position. Burry had actually been short Oracle before, through January 2027 put options. And he closed that earlier position just one day before this new disclosure, on August 5th, after what he described as a substantial profit. Less than 24 hours later, he was short Oracle again, this time through a direct equity position instead of options. That's not indecision. That's a trader taking a win off the table on one structure and then re-entering the same directional bet through a cleaner, differently risked instrument almost immediately afterward. He even wrote publicly that if volatility came back down, he might re-enter Oracle put specifically, which is more or less exactly what happened, just with a different vehicle than he originally hinted at. It's worth understanding what remaining performance obligations actually represent, because that single figure sits at the center of both the bull case and the bear case for Oracle at the same time. When a customer signs a multi-year contract for cloud computing capacity, the total value of that contract gets logged as a remaining performance obligation, even though Oracle hasn't delivered the service or collected the cash yet. It's a promise of future revenue, not revenue that's already happened. Bulls point to that $638 billion number as proof of overwhelming, already locked-in demand stretching years into the future. Bears, including Burry, point to the exact same number and ask a harder question. What happens to a company's stock price if even a modest percentage of those contracted customers can't or won't actually pay when the bill eventually comes due, after Oracle has already spent tens of billions of dollars building the physical infrastructure to serve them? Let's actually look at what Oracle reported that's fueling this bet, because the company's own numbers are genuinely a study in contradictions. In its most recent quarter, Oracle posted total revenue of $19.2 billion, up 21% year over year. Cloud infrastructure revenue, the part of Oracle's business most closely tied to the AI boom, surged 93% year over year to $5.8 billion. Oracle's remaining performance obligations, a figure that represents contracted revenue the company hasn't recognized yet, jumped by $85 billion in a single quarter, climbing from $553 billion to $638 billion. For context, that one quarter increase alone is larger than the entire annual revenue of most Fortune 500 companies. Oracle is also guiding for revenue growth of 27 to 29% in the current quarter. On the surface, that's an extraordinary set of numbers for any company, let alone one that's existed since the 1970s. But sitting right underneath those growth figures is the part Burry is actually betting against. Oracle disclosed $260 billion in additional lease commitments, overwhelmingly tied to future data centers that had not yet appeared on its formal balance sheet as of May 31st. Capital expenditures at Oracle surged to $55.7 billion for the fiscal year, and that spending helped push free cash flow to negative $23.7 billion. Read those two numbers together for a second. A company can be growing revenue by double digits, signing hundreds of billions of dollars in new contracted business, and still be burning through nearly $24 billion more cash than it brings in, because the infrastructure required to deliver on those contracts costs more, faster, than the revenue shows up to pay for it. Burry's specific critique goes one level deeper than just the spending pace. He's pointed at Oracle's depreciation assumptions, the accounting method companies use to spread the cost of expensive equipment, like AI chips, across several years, instead of counting the full cost immediately. His estimate is that if Oracle's depreciation assumptions turn out to be too optimistic, meaning the chips become obsolete faster than the accounting assumes, the company's reported earnings could end up overstated by roughly 26 to 27% by 2028. That's not an accusation that Oracle is lying about its numbers today. It's an argument that the accounting rules Oracle is using to report today's profit rely on an assumption: chips staying useful and competitive for 5 or 6 years. That doesn't match how quickly AI hardware has actually been getting replaced in the real world over the last several product cycles. The bond market has already started pricing in exactly the kind of risk Burry is describing, independent of anything he's personally said or done. Earlier this month, S&P Global Ratings downgraded Oracle's long-term credit rating one notch, from BBB to BBB, leaving the company just one step above speculative grade, commonly known as junk status. Moody's, separately, assigned Oracle a negative outlook, meaning a further downgrade remains a real possibility. Oracle's 5-year credit default swap spread, the same kind of real-time risk gauge we've looked at with other AI-linked companies, climbed to roughly 2 percentage points, its highest level in nearly 18 years. Oracle's 10-year bonds are now yielding somewhere around 6.5%, well above the roughly 5.7% typical for similarly rated debt. and firmly in territory, usually associated with companies carrying meaningfully more risk than an investment grade rating implies. There's one more detail buried inside that $638 billion backlog number that deserves its own spotlight. According to S&P's own analysis, roughly half of Oracle's entire remaining performance obligation figure is linked to a single customer, OpenAI. That means Oracle's single largest source of future contracted revenue depends overwhelmingly on one company that is itself not yet profitable and burning billions of dollars a year. Think about what that concentration actually means for risk. Oracle isn't just betting that AI demand broadly continues growing, it's betting, in large part, on the specific financial health of one customer. The same customer whose own spending commitments have shown up repeatedly across this entire AI build-out story, from Microsoft's cloud numbers to Nvidia's revenue guidance to now, Oracle's own credit rating. Now let's turn to the other name, because Nebius is a genuinely different kind of company than Oracle, and understanding that difference is the entire point of why Burry shorting both of them at once is worth paying attention to. Oracle is a 50-year-old enterprise software giant that pivoted hard into cloud infrastructure. Nebius, by contrast, barely existed in its current form 2 years ago. Nebius Group is headquartered in Amsterdam, and it emerged in 2024 after its predecessor company, Yandex.V, completed the sale of its Russian businesses for roughly $5.2 billion, following Russia's invasion of Ukraine. What remained after that sale was rebranded as Nebius Group, led by Yandex co-founder Arkady Volozh, and it relisted on the Nasdaq in October of that year with almost none of its old Russian search engine business left inside it. The company operates in a category the market now calls the neocloud. Instead of running a broad, general-purpose cloud platform like Amazon, Microsoft, or Google, Nebius does one thing at enormous scale. It buys massive clusters of Nvidia's most advanced chips, builds data centers to house them, and rents that raw computing power out by the hour to AI startups, developers, and large enterprises racing to train and run their own AI models. Neoclouds exist because of a very specific gap in the market that opened up when AI demand exploded faster than anyone expected. Renting a handful of Nvidia's most powerful chips from a traditional hyperscaler used to mean joining a waiting list, sometimes for months. Neoclouds like Nebius and its closest publicly traded rival, CoreWeave, built businesses specifically around skipping that line, offering faster provisioning and hardware configurations tuned purely for AI work without any of the older legacy cloud business slowing them down. That speed advantage is real, and it's part of why Nebius recently brought its first Nvidia Vera Rubin rack, the chipmaker's newest architecture, online at a data center in Finland, becoming one of the earliest companies anywhere in the world to deploy that generation of hardware commercially. Analysts covering the sector estimate the entire neocloud market could grow from around $25 billion in revenue in 2025 to something approaching $400 billion by 2031 if current growth rates hold anywhere close to their current pace. Nebius's growth numbers make Oracle's look almost modest by comparison. In its most recent reported quarter, Nebius posted revenue of $399 million, up 684% year over year. The AI cloud segment specifically, which is nearly the entire business, grew 841%. The company is guiding towards somewhere between $3 billion and $3.4 billion in total revenue for the full year. Nebius has also landed genuinely enormous named customers. Meta committed to a 5-year, $27 billion deal for dedicated AI computing capacity. Microsoft signed on for a contract reportedly worth up to $19.4 billion in future revenue. Altogether, Nebius says its total contracted backlog now sits somewhere close to $50 billion. And here's the detail that makes shorting Nebius feel almost audacious on its face. Nvidia itself is a strategic investor in the company. Nvidia has put roughly $2 billion into Nebius across multiple rounds and currently holds a stake in the company of around 9.3%. When the world's most valuable chipmaker is putting its own money behind a customer and publicly calling that customer one of the world's premier AI clouds, betting against that same customer looks, at first glance, like betting against Nvidia's own judgment. It's worth remembering, though, that Nvidia has taken similar strategic stakes in several neocloud companies at once, not just Nebius. A chipmaker spreading investments across multiple competing customers in the same category looks less like a conviction bet on any single company surviving, and more like a way of securing preferential distribution and demand signals across the entire emerging category, regardless of which individual neocloud eventually wins or struggles. That distinction matters because it means Nvidia's investment tells you less about Nebius specifically than it might first appear. But look underneath the growth story and you start to see exactly the same structural pattern Burry flagged inside Oracle, just at an earlier and more extreme stage. Nebius's long-term debt has doubled to $8.4 billion. Capital expenditure guidance has climbed to $25 billion. And And just recently, the company closed a $775 million senior secured debt facility, the first of its kind in the neocloud sector, backed specifically by its already deployed GPU hardware and by its contracted future customer payments. Think about what it means for a loan to be secured by hardware that depreciates as fast as AI chips do. If Nebius's GPUs lose value or fall behind the newest generation faster than expected, the collateral backing that debt is worth less than the day the loan was signed, even before you ask a single question about whether the contracted revenue behind it actually shows up on schedule. Nebius currently trades at somewhere around 60 times forward sales, an extraordinarily rich valuation multiple even by the standards of this AI cycle. The stock is up more than 126% so far this year, more than 200% over the past 12 months, and nearly 950% over the past 3 years. This is, by almost any measure, one of the hottest, best performing stocks in the entire market right now. That's exactly what makes this specific short so revealing. More than the size of either position or the exact entry price. Oracle is down more than 25% year to date and more than 43% over the past 12 months, a stock that's already been badly beaten up. Nebius is up over 126% year to date. Burry is shorting the loser and the winner in the exact same sector in the exact same week through the exact same underlying argument. That argument, stated plainly, is not about whether AI demand is real. Burry has never claimed the technology is fake, and he's never argued that Oracle's cloud business or Nebius's GPU rental business lacks real customers. His actual thesis, in his own words, is about companies carrying, quote, very fat, very large, easy-to-shoot obligations, meaning long-term lease commitments and infrastructure spending that dwarf what those companies are currently bringing in. This isn't the first time Burry has raised this exact concern in public. Earlier this year, in disclosures around his expanding Micron and Nvidia shorts, he argued that a very significant proportion of current and future AI demand isn't actually coming from genuine end customers at all. He described much of that demand as being financed through what he called circular arrangements, where money flows between a small handful of interconnected AI companies, chip makers, and cloud providers, with each transaction getting recorded as fresh demand, even though no truly new outside money necessarily entered the system. To support that specific argument, Burry pointed to the Bank for International Settlements, an organization that serves as a kind of central bank for the world's central banks, in its own 2026 annual report on financial stability. When an institution like that starts flagging the same structural concern a hedge fund manager has been writing about on Substack, it stops looking like a lone contrarian opinion and starts looking like a pattern serious institutions are independently noticing too. Put simply, both companies have signed contracts promising years of future computing capacity at today's chip prices to customers who are betting that AI demand keeps growing at roughly its current pace for years to come. Both companies borrowed or committed enormous amounts of money up front to build the physical infrastructure required to deliver on those promises. And in both cases, the gap between what's been promised and what's actually been delivered and paid for so far is measured in tens or hundreds of billions of dollars. If AI demand keeps accelerating at anything close to its current pace, both companies almost certainly grow into those commitments and come out looking brilliant for having locked in capacity early. If demand growth merely slows down, rather than reverses, both companies could still end up in serious trouble because the debt payments and lease obligations don't slow down just because revenue growth does. That mismatch, fixed costs on one side, variable and uncertain demand on the other, is the exact same structural vulnerability Burry spent years tracing through subprime mortgages before the 2008 crash. There's a near-term event that makes this particular pair of trades worth watching closely, rather than just filing away as another Burry hot take. Nebius reports its second quarter earnings on August 12, 2026, less than a week after this short was disclosed. That report will be the first real, live test of whether the market treats Burry's warning as a serious signal or dismisses it entirely. It's a genuinely awkward moment for a company to face that kind of scrutiny. Nebius has spent the better part of a year building a reputation as one of the fastest growing, best positioned companies in the entire AI infrastructure sector, backed by three of the biggest names in technology: Nvidia as an investor, and Meta and Microsoft as its two largest customers. A short seller with Burry's specific track record choosing this exact moment to step in front of that momentum is itself the kind of event that tends to change how other investors, not just Burry, start reading the company's next earnings report. If Nebius posts another quarter of triple-digit revenue growth, expands its contracted backlog further, and gives guidance that keeps pace with its recent trajectory, the stock has every reason to keep climbing. And Burry's short could get expensive fast in a stock this volatile. If growth decelerates even modestly, or if the company signals any tightening in financing conditions given how much of its recent expansion has been funded by debt secured against depreciating hardware, the market could reprice the stock very quickly in the other direction. It's worth being honest about the case against Burry here too, because a fair video doesn't just repeat one side of an argument. Nvidia's direct financial backing of Nebius is a real signal, not a marketing gimmick, and Nvidia has far more visibility into actual chip demand across its entire customer base than almost anyone else on the planet. If Nvidia genuinely believed the neo-cloud model was fundamentally broken, putting billions of its own dollars into one of the category's leaders would be a strange decision. There's also a purely mechanical reason. A short like this one on Nebius could go badly wrong for Burry, separate from whether his underlying thesis eventually proves correct. Remember that implied volatility above 100% that pushed him toward a direct equity short instead of options. A stock with volatility that extreme and short interest building on top of it is exactly the kind of setup that can produce a violent short squeeze if good news arrives before the bad news Burry is anticipating does. If Nebius's August 12th earnings beat expectations, traders who are short the stock could be forced to buy shares back quickly to limit their losses, which would push the price up even further, even if nothing about the long-term thesis actually changed. Oracle's bull case is just as concrete. $638 billion in remaining performance obligations is not a hope or projection. It's signed, contracted business that Oracle already has commitments to eventually deliver and recognize as revenue. Companies don't sign contracts of that size with a vendor they don't believe can execute, and Oracle's 93% cloud infrastructure growth suggests real. Paying enterprise customers are actually showing up, not just accounting entries moving between related parties. Oracle's own leadership has also been explicit that maintaining its investment-grade credit rating remains the company's top capital allocation priority, and it's already taking concrete steps to defend that rating, including raising equity through preferred stock issuances rather than piling on even more debt. A company actively managing its balance sheet in response to rating agency pressure is behaving differently than a company sleepwalking toward a crisis, even if the underlying spending numbers still look aggressive by any historical standard. There's also a broader pattern worth remembering about Burry specifically, one he's been transparent about himself. He's been early before, sometimes by years, and being early in a short position can look identical to being wrong for a very long, very expensive stretch of time. His own Nvidia short, sitting as his only currently losing position in his entire disclosed portfolio, is the clearest proof that conviction and timing are two very different things, even for an investor with his specific track record. It's also worth knowing that Burry isn't simply bearish on everything, which is easy to assume from headlines that only cover his short positions. In that same period, he's been adding to long positions in companies like Flutter Entertainment and Fiserv, and holding through recent earnings from Zoetis and Mercado Libre. He's also built a notable combined bet on Flutter and DraftKings as a contrarian wager against prediction market platforms eating into the traditional sports betting industry. That mix matters because it shows Burry isn't reflexively negative on the entire stock market or even the entire technology sector. He's making highly specific, name-by-name judgments about balance sheets and business models, betting for some companies and against others, often in the very same week. That's a meaningfully different posture than someone simply calling for a crash and shorting everything in sight. Burry has also connected his AI skepticism to a broader macro warning, separate from any single company's numbers. He's pointed to falling market volatility and record-high stock indexes as evidence that investors have become dangerously complacent, drawing a direct comparison to conditions right before the 1987 crash, when a calm, confident market reversed with almost no warning. His argument isn't that a crash is guaranteed on any specific date. It's that low fear, combined with high leverage sitting quietly off balance sheets, is exactly the environment where a shock tends to travel faster than anyone expects going in. Burry addressed that tension directly in his own writing, and it's worth repeating here because it's more honest than most hedge fund commentary you'll ever read. He said plainly that shorting is not for everyone, that he personally must short because of how he's built his career and his fund, but that most people should not be doing what he does. That's not false modesty. It's a direct acknowledgement of the lopsided risk we walked through earlier, coming from the one person in this story who actually carries it. So where does that leave you, watching this unfold from the outside, whether you own either of these stocks, both of them, or neither? The specific, narrow thing to watch is Nebius's earnings on August 12th, because that report will either extend the company's remarkable growth streak or start to show the first cracks in a business model built on borrowing heavily against equipment that ages faster than the loans backing it. There's a second thing worth watching closely on that same earnings call, beyond just the revenue growth headline. Pay attention to whether Nebius gives any update on financing costs or covenant terms tied to that $775 million secured debt facility, because that loan's structure, backed directly by depreciating GPU hardware, is precisely the kind of collateral arrangement Burry's entire thesis is built around questioning. A lender's willingness to keep extending credit on those terms, or its reluctance to do so again, will tell you a lot more than the headline revenue number alone. The broader thing to watch, well beyond just these two stocks, is whether more AI infrastructure companies start disclosing the kind of off-balance sheet lease commitments Oracle just revealed, because $260 billion showing up outside a company's formal balance sheet is exactly the kind of hidden leverage that tends to only become visible after it's already caused a problem. Burry built his entire reputation finding exactly that kind of hidden leverage before anyone else was looking for it. Also, keep an eye on credit markets generally, not just equity prices, across the entire neocloud and AI infrastructure sector. Oracle's credit default swap spread hitting an 18-year high, and its bonds trading at yields closer to speculative grade territory than investment grade happened weeks before Burry's public disclosure. The bond market, historically, has a track record of pricing in trouble before equity investors fully catch on, which is exactly the pattern that played out in the run-up to 2008, the crisis Burry is most famous for calling early. None of this means you should copy Burry's trades, and he's said as much himself. What his disclosure does tell you, cleanly, is where one of the most scrutinized skeptics in modern investing has decided to point his attention next, and it's notably not at the company most people assume is the biggest risk in this entire AI trade. It's at the two companies quietly carrying the debt and the lease commitments that make the whole AI infrastructure build-out physically possible in the first place.